Okay, let's get started. What I'm going to show you in this video is to set up the Iron Condor from scratch. And on your Thinkorswim platform, you want to go to the Trade tab and put in this index that we're going to set the Iron Condor upon. And the ones that I do are the real safe ones. They're Diamonds, IWM, the Qs, and SPY. These are index ETFs, and they're accumulated of many stocks, at least 100 or more. Some are 500, some 2,000. And the chances of all of those stocks crashing is very rare, highly rare. So those are very safe stocks, options to start with. So we're going to put the Qs in to start off with. That's three Qs. Hit enter. And this brings up the option contracts that are available for us to buy. And for us, we looking at doing 30 plus days of expiration to execute our stock options. And as far as learning, the yellows are the weeklies, which means they expire every week. And the numbers here is the expiration, the number of days till expiration from the current date. So the October 15th, 7 days, and this right here is 14 days, 21, 28. So we can go here to November 15th. That's 35 days for expiration, or we can go to December 16th. December 15th was 63 days expiration. So I have a position already on November 14th, and for this video, we're just gonna go to the December 15th. So we hit the arrow to bring up the options, the strike price options. You're gonna have to adjust your view to 40. Yours may have a default of 4. Once you do that, you're going to be able to see all of these options that are available for trading. And you may also want to adjust this tab. You're going to have a heading, 4 headings: the bid price, the ask price on both sides. And what I mean by sides, we got the put side and we got the call side. Puts, always keep in mind, put is when you want stock to go down. So remember, you put stuff down. And call side is when you pick up the phone, you call someone up. So remember, calls go up. So that's just a quick way to remember what puts and calls are. If you heard somebody talking puts and calls, you know they're. So I put a put option down, I did a call option down. You got a general idea what they're doing. So so you want to change yours to Delta just by clicking on whatever yours have there and change it to Delta. Delta is one of the Greeks. There are four Greeks that we look at. There's Delta, Gamma, Theta, and I think there's another one called Rho. And you should get a little bit idea what those are. Google it, YouTube it, and get an idea what the deltas are, what the gammas are. Now, to explain a bit more on the screen, what you're seeing here, the purple shade mean this is on the call side. This is called in the money. That means the price all the way up to 107, today's price. Right now it's 107.75, and it's separated by purple for in the money and out of the money. I mean, from the call side, it means it hasn't happened yet. It's out of the money on the call side. On the put side, it's the opposite. The in the money is going to be 108 because you want to put you got the puts over here 108 and below. I'm sorry, 108 and higher is the in the money, and now the out of money on the put side is the black shaded area. Now to get started as a buffer on the delta column, I like to start in the calls. You can do calls or puts, but always on my delta column, I go to the 0.20, the first price below 0.20. And since there's no 0.20, I go to the next one, it's 0.17. So what I'm going to be choosing here is this one, and its price right now is at 114. And the next one is below that, for the 0.14s, and its price is 114. So on the put side, there is a 0.20, so we're going to choose that price. It's 100. And then one below that is 0.19, it's going to be 99. So let's get it executed. You just right click, highlight 0.17, right click, hit sell, and then scroll over to Iron Condor. And that puts our prices in for us. And on the call side, that's how we executed it. And on the put side, we got to change it. Remember we said 20 was 100, and then 0.19 is 99. So we're going to put 100 here. Always put the higher number where the higher number goes, and then the 99 is here. And this right here is a liquidity index checker. It shows you the difference of the bid and ask. Here we go. We got a point. We have a 3 cent difference right here. So this means the stock is pretty liquid. 2 or 3 cents difference. It's pretty liquid. It changes. Anything below 5 cents is anything 5 and below is pretty liquid. All right, now we got our order set up and we got our correct numbers in there. We're going to look at it graphical to make sure that it will capture the full potential of profit and also the probability. So this video is that will be in the next video. And let me just get you going to what this is going to look at graphically. You're going to go to the any open area shaded area. You're going to right click and you're going to hit analyze trade. And that switches us to the analyze tab. And this brings up our iron condor. This is the body of the bird and these are the wings. This is one wing here, there's one wing here. And here's our trades. This is only, remember the put side is below the price, the 100 and the 99. This is the median price right here in between those. And here's on the call side, the 114s and 115s, and here's the break even, the mid price. So if we notice this gray highlighted area, by default it's one standard deviation from this price on both sides. Plus one standard, minus one standard. And it's a 68%, 68.27%. And this expires on the 15th, December 15th. So we notice that our put side is perfect. It captures that. And this probability range is based off the historical prices. So we notice that we're a little bit short on the call side. So we want to increase this to be on the safe side to capture this one standard deviation. As a beginner, you want to start off pretty general, pretty broad deviation. One standard is really good. So we're going to change this. And we notice this 115, it's a little bit higher than 115. So to capture that, we can go at 116, 115. So let's go on to our call side and change that to 116 and 115. Now I got a 1 point gap from a one point gap from my prices. I got the 116, 115. You can actually do a 115, 117 or 116, 114. You can do that on either side. You can do 2 points, 1 point. You can play around with it and see what looks better as far as liquidity. Right now we have 1 point and we're gonna capture 27 credit on one contract. And right now we have 10 contracts. So if we highlight this anywhere in the body, right now it went up to 28. See, it went up to 28. So anywhere in the body this cursor goes, look at this section here. It shows you the profit, 280. And if you go to the wing side, pass out break even is where we lose. So we could lose up to 720 on that side and on this side, 720. Now that's just a general rough estimate. It'll show you when you put your order in. It'll show you it's precisely how much you will profit you make and how much profit you could lose. So now with the adjustment here, doing adjustment in the beginning of the trade helps you so you don't do that during the execution of the trade, because you can come back and we can set this trade off and we can make this adjustment again. But we have to sell and buy back, because keep in mind each side of this iron condor is made up of two sides. We're going on the put side, we're going long up, and then we're shorting the hundreds. That's where this graphical comes into play right here. And on the call side, we're shorting the 116s and we're going long on the 115s. That's where you get this little side of the iron condor. So those two sides together make this iron condor. This S right here on this side and this S on this side together makes this iron condor. Okay, so that's how we set up the iron condor.